Hi, everyone. So welcome to the live stream today. Very much excited for having you back with our series on the IFRS Masterclass. Very much excited for having you. In case you missed the sessions for the beginning of this IFRS Masterclass, you can check the description of this video. I've left it there. I'm leaving it there. You can click on it and go and watch the entire IFRS Masterclass as we've started for 2021 in order for you to prepare well for your examination. I see some of you guys already joining the stream. Welcome to the stream. I'm very much excited for having you. Smash the like button when you join the stream. That way we get more engagement on the video. But most importantly, I want you to comment in the chat box any questions you have for me, topics that you would want me to cover on the channel. Put it in the chat box for me. I'm going to be reading all of your comments and reply to all your comments. And also make sure that you share the channel, share the video. Let's reach as many students as possible preparing for the ICA, the ACCA, the CIMA, the CPA, and other forms of accountancy examination so that we can reach many students and together assist a lot of students to become more successful. So welcome to the stream. This is IFRS Masterclass. Our focus today is to look at two key accounting standards in the IFRS, and that is going to be IAS 36, Impairment of Assets, and IAS 38, Intangible Assets. I'm very much excited about these two standards because of how related they are. We are actually going to be starting with IAS 38, Intangible Assets, and as we proceed in the discussion, IAS 36, Impairment of Assets, is going to bring itself automatically or originally so that it will be able to build our knowledge in that case. So welcome. I see some comments coming in already in the channel. Let me look at them real quick. And please help me. I'm on a new audio device. So let me know if the sound is okay. I'm on a new audio device. And even though we tested it before the live stream, let me know if the audio is okay. You can hear me well in the chat box. Just help me to make sure that the audio is working well so that you can hear me properly in that case. So Holy T said, please say, I would love you to do a short video on IFRS 16, please. I'm really having difficulty with that standard. Now, I already have a video, a two-part video, or it's a four-part video actually on IFRS 16, Holy T. So you can check the playlist, Accounting Standards Lectures on the channel, and you see IFRS 16, or you can just search for IFRS 16 and my lecture should pop up in the first 3 or the first 5, IFRS 16. I did a 4-part lecture video on that. You can check that out on the channel and then start watching that before I do some other lecture on that later on. Felix Colbeck said, first time joining and I'm expecting nothing but the best. All right, Felix, you are welcome to the stream. Smash the like button for us. That way it helps us a lot. Kayana Kwalamba said, good evening, sir. Good evening, Kayana. Forgive me if I don't mention your name right, okay? Forgive me if I don't mention your name right. Okay, so Holy T said, Mike, okay. Thank you very much for assisting me to test this. Thank you very much. Okay, so we want to go straight up into our discussion. This is the IFRS Masterclass. Remember, I told you, and I keep on telling you all the time that to be able to pass your corporate reporting examination or your financial reporting examination or the advanced financial reporting exams, you need to be strong in the international financial reporting standards. It is for this reason why I'm taking you through these IFRS Masterclass sessions to enable you to break down the basic accounting standards that you need to understand in order for you to prepare yourself for the examination, pass the exams, and most importantly, take your life to the next level. So let's go straight up into the discussion. Let me share my screen with you, and then let's see how we can go into today's discussion. Okay, so let's see what I got here. So this is IAS 30. And you can see in the backdrop, that is my advanced taxation book. Can be used by students writing the principle of taxation and advanced taxation. It's a combined manual, and it is 120 Ghana cedis. So as you see it in the backdrop like that, it is a book that you can get a copy for. You can get a copy if you are writing the ICA examination, doing principle of taxation and advanced taxation. It's a combined book to help you to be able to prepare well for the exams and pass the exam. So let's go straight. Let me share my screen with you. Okay, so let's see. All right. So my screen is now visible to you. Ellen Nicholas said, the audio is perfect. Thank you for the lecture. Always a pleasure. Thank you, Ellen. Kwenu Letopo said, thank you, sir. We really appreciate your efforts. Always a pleasure. Always a pleasure. All right, so let's get into the discussion. IAS 36, Impairment of Assets. And then IAS 38, Intangible Assets. Right. So we want to go straight up into the discussion. Very much excited about it because it's going to help you to be able to understand what it's going on there in that case. Let's look at it. So we're going to start a discussion first with IAS 38, that is intangible assets. And like I said, as we proceed with the discussion, IAS 36, impairment of assets, is actually going to be showing up in that case. So we're going to be looking at that one after the other. So let's start the journey with IAS 38, intangible assets. Intangible assets. Like I tell you all the time, when you pick the standards app, a number of things must occur or must be known to you when you pick the standards app. That is the objectives of the standards, key definitions, recognition criteria, initial measurement, subsequent measurement, and what? Disclosure requirements. So let's see how we can go into the discussion real quick and see how we can excel in that case. So let's go. IAS 38. Now, the objective of IAS 38 is simply to prescribe the accounting treatment for intangible assets that are not dealt with in another IFRS. Now, there are a lot of intangible assets, but the main objective of IAS 38 is to prescribe the accounting treatment of intangible assets that are not dealt with in other standards. But the key question we ask ourselves is, what are intangible assets? So when we say intangible assets, what are intangible assets? Stay with me carefully here as we begin the journey real quick. IAS 38 defines intangible assets as, non-monetary assets without physical substance. Non-monetary assets without physical substance. Non-monetary assets without physical substance. That is what we mean by intangible assets. So off the bat, somebody will ask, okay, so what are monetary assets? What are non-monetary assets? In a simple language, monetary assets are money held and assets to be received in fixed or determinable amounts of money, such as cash and trade receivables. So monetary assets are money that has been held or assets that an entity is going to be receiving somewhere in the future. So monetary assets, example will be cash in hand, all right, cash at bank, trade receivables. These are monetary assets. These are monetary assets. But intangible assets are non-monetary assets. Non-monetary assets. So example, there are a lot of examples of intangible assets that we can talk about, but let me give you a couple of them. Goodwill, computer software, patents, customer list, franchise, brands, research and development, all these are examples of intangible assets. All these are examples of intangible assets. All these are examples of intangible assets. So goodwill, computer software, patents, customer list, franchise, brands, research and development, all these are examples of intangible assets. So what are we saying again? Intangible assets are non-monetary assets without what? Physical substance. Non-monetary assets without physical substance. And we've given a couple of examples already that goodwill, computer software, patents, customer list, franchise, brands, research and development. Please note that IAS 38, that is the standard IAS 38, pays significant attention to the treatment of goodwill as well as how research and development is to be treated. IAS 38, the standard, pays significant attention to how goodwill is supposed to be treated and research and development is supposed to be treated. So we're going to also pay close attention to how these two items will be treated in a moment. If you have any questions, you know what to do. You put it in the chat box. If there is anything you don't understand, you put it in the chat box and I'll retake it and assist you to be able to understand it much better. But a question we ask ourselves is, what is the scope of this standard? So what is the scope of IAS 38? What does IAS 38 cover? What does it cover at the end of the day? Number one, it covers financial assets that are accounted for in accordance with IFRS 9, financial instruments. So the way we account for financial assets, they are part of intangible assets. So if an organization acquires some financial assets, we deal with them later on, and we will talk about these later on in that case. Another one is intangible assets arising from insurance contracts. Intangible assets arising from insurance contract. This one also, I will touch on it later on, that we need to understand. Then exploration and evaluation of assets. This is under IFRS 6, exploration for and evaluation of mineral resources. That is also another class of standard. But we are not much excited about these because we're going to be just dealing with the real deal in a moment. So let's go to recognition. To deal with the issue about recognition of intangible assets, the first thing we talk about is what? The recognition criteria. So what is the recognition criteria for intangible assets? Number one, it must be separately identified, okay? So the assets must be identifiable. Now, when we say the asset must be identifiable, it means that it can be purchased, rented, or sold separately. Okay? It can be purchased, rented, or sold separately. It must be purchased, sold, or rented separately. I see a question coming on. Benedict Amankwa said, thank you, sir. Do you have to pay before you watch live? No, our YouTube live streams are free, but we have our paid courses, which is 390 Ghana cedis per paper. That one is where you get access to the full course on our online study portal, the ebooks, the lecture videos, and you'll be joining our weekly live Zoom sessions. Okay, so we have a paid program. The YouTube, that one is open to the public. It's everybody, and it is free. You don't have to pay anything to me before you join. All you have to pay is to have your data. So our YouTube live stream, these are free, but our paid program is there. That is 390 Ghana cedis per paper, and you get access to the ebooks, the lecture videos, the question kits. Then you'll be able to also join our weekly Zoom sessions. Then I'll be able to hold your hand directly so you can study under my mentorship to prepare for the exam. So Benedict Amankwa, if you are asking about payments, that is what you need to understand. So number one, the asset must be identifiable. We said, or we are saying that the asset is identifiable when it can be sold, rented, or purchased separately. That's the first thing. Number two, it is probable that the future economic benefit will flow to the entity. It is probable that future economic benefit attributable to the assets will flow to the entity. So that is the second thing. So the first thing we are saying here is that it must be what? Identifiable. Second thing, future economic benefits must what? Flow to the entity. So separately identifiable means that what? It could be purchased, it could be sold, it could be rented separately. Three, that the cost of the assets can be measured reliably. The cost of the assets can be measured reliably. So that is the recognition criteria for intangible assets. So it should be separately identifiable. Future economic benefits from the asset will flow to the entity. The cost should be reliably measured. Ellie Nicholas said 390. What currency, may I ask? That is 390 Ghana cedis. 390 Ghana cedis. So wherever country you are at, or whichever country you are at, you can just do the exchange rate on Google. Then you'll be able to get the exchange rate in. That's about $68, I guess. Yeah, somewhere around $68. Messi Gomez said, good evening. It is another great opportunity to join the live stream. Thank you for the opportunity. God bless you. God bless you too, Messi. Queenie said, could you please write more clearly, meaning that it's not visible? Okay, I hear. I'll try to do that. So number one, assets can be separately identified. And number two, it could be able to, the future economic benefit will flow to the entity. And then three, costs can be reliably measured. Now, remember I told you that I gave you some examples of the intangible assets. We mentioned that these are examples of intangible assets, but if you remember, I told you that the standard paid close attention to research and development, and we also want to pay close attention to research and development and look at how research and development as well as goodwill has to be treated. So before I get into initial recognition, subsequent measurement and all that, let's look at research and development and then treatment of goodwill. So R&D. So research and development. How do we treat research and development as per IAS 38? Let's begin the journey with research. Let's begin the journey with research. Now, when we say research, what is research? When we say research, what is research? In a simple language, research is original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. Okay? So research is original and planned investigation, okay, with the prospect of gaining new scientific or technical knowledge and understanding. Technical knowledge and understanding. So in a simple language, research has to do with a planned investigation by an organization to gather information about an existing product or a potentially new product. So for instance, let's say we are producing whatever. Let's say we are producing Sobolo, and for some reason, we want to find out what people want more of our Sobolo in relation to that. And we want to find out and gain more understanding in the markets. We can launch a research campaign where we go out there to gather information about the clients, about our customers, so that we find out what ingredients do they want in this, that kind of thing. So research is a planned investigation to gather information about an existing product, or it could also be a potentially new product, a potentially new product. So that is the idea about research. Now, examples of how does the standard says we should treat research. So treatment of research expenses. Now, the standard states that all research expenses must be written off. All research expenses must be written off. All research expenses must be written off in the income statement as incurred. All research expenses must be written off in the income statement as incurred. You're going to stay with me very well here. But there is another thing you need to understand about research expenses. The standard went ahead to say that any capital expenditure incurred in research, any capital expenditure incurred on research should be capitalized on research equipment, should be capitalized and amortized or depreciated over the economic useful life of the asset. So stay with me carefully here. Two things are coming up. One, all research expenses should be written off in the P&L account, in the income statement, as and when we incur it. Two, any capital expenditure incurred on research equipment should be capitalized and depreciated or amortized over the economic useful life of the asset. Now, what exactly do we mean by that? So let's say that we want to have a research team. So I'm explaining this concept. So let's say that we employ 10 people, and these 10 people, we give them an iPad Pro, and they all have iPad Pro. So we gave them 10 iPad Pro. And let's assume that maybe the entry level, so it's $1,000. Let's assume that $1,000 iPad Pro. So so that is the iPad they have. On the iPad, we also have a specialized software that helps us to gather the information, and that software was built incurring a cost of say $5,000. Now, these 10 people, they are going to be getting some allowances. Okay, we will give them transportation, and then we will give them some other maybe hotel or other accommodation allowances. So stay with me carefully here. So what is going on here? What the standard is saying is that all research expenses should be written off. However, any capital expenditure incurred on research should be capitalized. So what does that mean? It means that the 10 people, the allowances we give them, their T&T, the hotel that they will stay at, those expenses are revenue expenditure. For that reason, we write them off in the profit or loss account as and when we incur them. However, the cost of the 10 iPads cannot be written off. The cost of the software that we've developed can also not be written off. So the standard states that those capital expenditure should be capitalized and depreciated or amortized over the economic life of the asset. So if it is a software, then we will amortize it over the economic useful life of the software. If it is the iPad, we will depreciate the iPad over the economic useful life of the asset. That is what we mean by research expenses, and this is how research expenses are treated. Does it make sense? Well, I see some of you guys joining. Welcome to the live stream. This is the IFRS Masterclass. Click the like button. When we do that, we get more engagement on the video, and YouTube will be able to push the video so we can reach as many students as possible. It helps us for the channel to also grow to reach a lot of students. Then also comment in the chat box any questions you have for me, your thoughts, so that we can know what we have to cover on the channel. Nicole Williams said, good day, sir. Hi, Nicole. I hope you're doing well. I think you asked for the IFRS Masterclass yesterday or so, or 3 days today. And so here we are back to the IFRS Masterclass, and I hope that you are getting some value already. Yahawa Sadiq said, sir, I thought you should be treating man accounting at this time as you stated yesterday. Yes, we wanted to take management accounting, but along the line, we realized that there were a lot of requests also coming in for the financial reporting, the standards. So we decided to today chip in some IFRS Masterclass as well in there. Jeremy Roos said, I registered yesterday for FR and FM, but I have not been added to the WhatsApp page yet. Jeremy, I told you to send hi on WhatsApp. Did you do that? If you send hi on WhatsApp, you should be added to the group, and because we will confirm your email address and the subject, then you'll be added to the WhatsApp group. Because today is financial management. So you should be able to join the financial management discussion this evening. So please send hi on WhatsApp if you have not. If you have also send in your email and the number so we can confirm your enrollment and be able to add you to the WhatsApp page. Leonard Montandi said, good evening, sir. Good evening, Leonard. Francisca Boachi said, good afternoon, sir. Good afternoon, Francisca. I hope you're doing well. Ronnie Lawrence said, hi, Nhyira. The presentation is very clear and to the point. Thanks. Always a pleasure. Jeremy said, how do I join the class today? Jeremy, please send hi on WhatsApp. You will be added to the group so that you will be able to join the class, because when you are added to the group, the Zoom link, the meeting IDs will be posted on the group so that you'll be able to join the class when it starts at 6 p.m. So please send her on WhatsApp and you'll be added to the group, Jeremy. And please note that our lectures are ongoing for the May 2021 examination. So if you want to enroll and study directly under my mentorship at 390 Ghana cedis per paper, you get access to our lecture videos, the ebooks, the question kits, and most importantly, you'll be learning under my mentorship and joining our weekly live Zoom session. So you can head on to NhyiraPremium.com. The link is in the description or pinned to the comment or the chat here. You can click on that and enroll in the course today and join us so that we can assist you better. Muntara said, good evening, sir, from Celerion. Yep, welcome to the live stream today. So that is it about research. That is it about research. So let's go to development. Development. So remember what we are saying. We are saying that IAS 38 paid close attention to the treatment of research and development, as well as what? As well as the issue in relation to Goodwill. So we've looked at research and the treatment of research. Now we want to look at Goodwill. Benedict Amankwa said, how can I get the previous lectures? Benedict, which previous lectures are you talking about? Have you enrolled in the course? If you have enrolled in the course online, you can send hi on WhatsApp, or on the study portal, you'll be able to get access to all of the lectures on our study portal. So if you have enrolled in a course and paid money online, you can send hi on WhatsApp, on our WhatsApp line 050-114-9296 and be able to get access. So what is development? If research has to do with a planned investigation in gaining new information about a product or a potentially new product, then what is development? In a simple language, we said that development is the application of research finding or other knowledge to a plan or a design for the production of a new or substantially improved material. Okay? So development is the application of research finding. Is the application of research finding. The application of research finding to plan or design for the production of a new or substantially improved product or service. So usually the issue about development is it is using the information obtained from the research to develop product prototype or increase the quality of an existing product. Give me a moment. What's wrong with my lights here? All right. So that is it. When we use research finding to gather information, what we are doing is when we use research finding to develop product prototype or improve upon an existing product, that is development. Now, the standard states that intangible assets arising from development shall be recognized if and only if the following criteria is met. In other words, let me take that again. Development cost, all development costs shall be capitalized. All development costs shall be capitalized if the criteria below is met. In other words, when it comes to development costs, you don't just get up and capitalize it. You don't just get up and say, I'm going to treat it as an intangible asset on the face of the financial statement. No. Before we make that decision on treating it as an intangible asset on the face of the financial statement, the criteria below shall be met. The criteria below shall be met. So we call it the sector recognition criteria. Sector. So 6. Please note that where the criteria is not met, then the development cost shall be written off. Where the criteria is not met, then development cost shall be written off. That is very, very important. Where the criteria is not met, development cost shall be written off. So what is sector? The S here simply means that it should be a separately identified project. So it should be a separate project. And I've said this already, that when we say something is separately identifiable, it means that it can be purchased, it can be sold, and it can be rented separately, individually, on its own. So it should be a separately identified project. 2, that the cost incurred can reliably be measured. So estimation of cost reliably. The development cost that we are going to be incurring in the production of the goods, in the development of the product, or the improvement of the existing product, the cost should be reliably estimated or reliably measured. But not only that, the fact that it is a separate project, the fact that the cost can be measured reliably, doesn't mean we can sell it. So C means that there should be a commercial value. There should be a commercial value. Now, when we say there should be a commercial value, what exactly are we driving at? When we say there should be a commercial value, it means that there has to be a ready market for the product. There has to be people who are going to be buying the product. Because remember, our objective as an organization is to maximize the wealth of what? Shareholders. And so you don't want to take shareholders' money to develop a product that has no market, to develop a product that has no demand. So in order for the organization to achieve the goal of maximizing the wealth of the shareholders, what do? The product we are developing should have a commercial value. There has to be a ready market. There has to be demand for the product. But the fact that the product has a market doesn't mean we can actually do it. So T simply means it should be technically feasible. It should be technically feasible. It should be technically feasible, meaning that it should be something that the organization can do. We are developing a product. Is this something we can do? So maybe from the research finding, we realize that customers want a couple of specifications. Customers want a couple of features. Can we do it? Can we carry it out as an organization? So technically, it should be feasible. Technically, it should be feasible. That is very, very critical there. That is very, very critical there. But you see, the fact that we can develop a product in-house, the fact that there is a market for the product, does not mean we will actually make profit when we actually develop the product. So O here simply means overall profitability. So on the overall, the commodity, the product we are developing should be profitable. Now, the fact that there is a market does not mean we will be profitable. Because sometimes if the market is small, or if the market is segregated in such a way that it is in the low income earners, that means we will not be able to maximize the wealth of the shareholders. That means we will not be able to maximize the wealth of the shareholders. So number one, it should be separately identified project, meaning that it could be sold separately, rent separately, and purchased separately. 2, the cost, that is the development cost, should be reliably estimated. 3, there has to be a commercial value. There should be a ready market. The organization should be able to determine that, oh, we can sell this product in the market because there is a demand for the product in the market. Then 4, it should be technically feasible. What does that mean? It simply means that the organization should be able to carry out the project. The organization should be able to produce the product in question. And then O means overall profitable, meaning that the fact that there is a ready market for the product does not mean that we are actually going to be profitable with the product. So we should be more profitable on the product. And R means there should be resources available to complete. Resources available to complete. Now, the good thing that you got to understand here is that you can start something, right? But if you're not able to carry it to the end or complete it, then why start it in the first place, right? So there should be resources available. Now, when we say resources available here, we're talking about money, funding, we are talking about expertise, we are talking about the machinery, and we are talking about what are the 4 M's of resources? So men, labor, money, capital, machine, and then what? There is a 4th one. I've forgotten that. You can find that out later on. But we should have all the resources we need to be able to produce the products that we require in that case. So IAS 38 states that if this recognition criteria is met, then the entity can capitalize the development cost. In other words, the entity can recognize an intangible asset on the face of the statement of financial position for the development cost. But the big question we ask ourselves is this: will all these be available in the question? In other words, when you are reading the question, will you see that it is separately identified? Will you see that the cost has been reliably estimated? Like all of them, can you find all of them in a question? Technically, most of them are implicitly stated in the question, whilst others must be explicitly stated in the question. Okay? In other words, there are some of them we can just infer from the question, but others must be categorically stated in the question. To be able to determine whether a development cost can be capitalized or written off, one indicator is the 3rd one, commercial value. The point at which the organization realizes or determines that the product has a market, it means from that point till the product becomes ready, we can capitalize the cost. However, any cost we incur prior to the point at which the market value is being determined, that should be written off as incurred in the profit or loss account. So commercial value is going to be something that will stand out throughout. Then the technical feasibility could also be something that could stand out. The technical feasibility. So normally, separate project, it will be implicit in the question. The cost should be reliably estimated because they will tell you the cost that the organization is incurring. Overall profitability sometimes is implicitly stated. Then resources available to complete. That one also, once in a while, it could be a critical issue in the question. It could be a critical issue in the question. But the one that stands tall in all of these is the commercial value thing. The commercial value thing. Any questions? This is how we treat research and development as per IAS 38. As per IAS 38. I see some of you guys joining. Welcome to the live stream. Smash the like button when you join the live stream. It gives us more engagement on the video, and YouTube will be able to push the video so we can reach as many students as possible. In case you've not subscribed to the channel, also subscribe to the channel, become a VIP member, and click the bell notification icon. That way, when I go live, you'll be the first person to be notified by YouTube, and you'll be able to join the live stream. Or when I release new content on the channel, you will be notified so you can join and be part of the live stream. Thank you very much. I see some of you guys smashing the like button. Leonard said, when do you have management accounting? Leonard Muntaka for Zambia. In order for you to know what we are going to be discussing for each day, you can follow me on Instagram. Okay, so follow me on Instagram at Nhyira Premium, because each day's discussion is usually posted on Instagram in the morning, so that you'll be able to know that, okay, today, this will be the discussion on the live stream. Then you can prepare. If it is a subject that you are doing, then you'll be able to join the live stream. So you can follow me on Instagram at Nhyira Premium, because we post the meeting details there, the topics for the discussion there, so that you can join us in that case. Benedict Amankwa said manpower. No, manpower is like men. Manpower is like men. Because we have men that is labor, money that is capital, machine. There is another one. There are 4 M's there. Maybe we can talk about that later on. All right. So that is how we deal with research and development. Then the next thing I told you that IAS 38 paid close attention to is the issue about goodwill. Goodwill. Now, according to IAS 38, goodwill has to be treated in a certain way. There is a way that an entity can treat goodwill in its books. There is a way it can be treated. But the first thing we do is to ask ourselves, what exactly is goodwill? So when we say goodwill, what is it? Now, IFRS 3 business combination defines goodwill as future economic benefits arising from assets that are not capable of being individually identified and separately recognized. So according to IFRS 3 business combination, goodwill can be defined as future economic benefits arising from assets that are not capable of being individually identified and separately recognized. All right. So assets that are future economic benefits arising from assets that are not capable of being individually identified and separately recognized. So that is the standard definition if you want to for goodwill, or to define goodwill. Now, usually goodwill could arise from any of the following: quality of product or service, can bring in goodwill. The loyalty of customers can bring in goodwill. Good reputation of an organization can be part of its goodwill. The competent workforce that we have can be our goodwill as an organization. Then good customer relation can also be goodwill. So what are we saying? According to IFRS 3 business combination, goodwill can be defined as future economic benefits arising from assets that are not capable of being individually identified and separately recognized. Goodwill can arise from any of the following: quality of product or service, customer loyalty, good reputation, competence of workforce, good customer relation. Good customer relation. All these can be goodwill. Now, how should we treat goodwill? How should we treat goodwill? IFRS 3 prohibits entities from treating internally generated goodwill. So, IGG, internally generated goodwill, must not be recognized, in the accounts, in the financial statement, because it does not meet the recognition criteria for intangible assets. So entities, organizations, companies are prohibited from recognizing internally generated goodwill. However, goodwill arising from purchases of another business can be recognized in the financial statements. Goodwill arising from purchases of another business can be recognized in the financial statements. So that is the thing you need to understand about goodwill. Now, when we say internally generated goodwill, what does it mean? For instance, we say that, okay, if we look at the rate at which our YouTube channel is growing, the number of students that we are touching in Ghana, in Africa, and across some part of the world, and the kind of influence we have online, because of that, the name Nhyira Premium, goodwill for that is $100,000. Then we include that in our books as an organization. It is called internally generated goodwill. We didn't incur any costs in that. We might not incur any cost in that. We just sit down and did some evaluation, which doesn't make any sense. So if the company sits down and just place a value on something unrealistically, it becomes what? Internally generated goodwill. So we cannot recognize such an item in our financial statement as what? Goodwill. That because of the influence we have online, the name Nhyira Premium should be recognized in the books, in our books, at $100,000. No. However, Nhyira Premium is a registered trademark, and if it is a registered trademark, that means that we could account for it as a patent in our book, as a trademark in our book. That one, we incur the cost for registration, we incur the cost of all of those things, so that will be recognized in the book. What are we saying here? Internally generated goodwill. Goodwill that the entity itself determines cannot be recognized in the book. Only goodwill arising from business acquisitions or purchases, that is what can be recognized in the book. This is what you have to understand when it comes to the treatment of goodwill, research, and development. And these three things, the IAS 38, the standard, paid critical attention to them. How you treat goodwill, how you treat research, and how you treat development. Any questions for me, please? If you have any questions, put it in the chat box for me real quick. Put it in the chat box for me real quick, if there are any questions for me. All right. So that is the idea about these. So we've looked at the recognition criteria, that it should be a separately identified asset. It is probable that the future economic benefits attributable to the asset will flow to the entity, and the cost of the assets can reliably be measured. Then we've mentioned the issue about research. We said all research expenses should be written off in the income statement on the profit or loss account as and when they are incurred. However, capital expenditure on research should be what? Capitalized and amortized or depreciated over the useful life of the assets. But when it comes to development, we are saying that development costs can be capitalized only when the recognition criteria is met. And what is the recognition criteria? Sector. It should be a separately identified project. We should be able to estimate the cost reliably. It should have a commercial value. It should be technically feasible, overall profitable, and most importantly, there has to be resources available to complete. So these are the things you need to understand about that. Then we came to Goodwill, and we said in accordance with IFRS 3 business combination, internally generated goodwill cannot be recognized. However, only goodwill arising from business acquisition or business purchases can be recognized in the books of the organization. Paul Amoako said, hello, sir, please, I need a lecture on financial risk management in FM. Unfortunately, we don't have that content available on YouTube. You can get that content in our paid program on financial management on our study portal. So currently, we don't have that content available on YouTube. It's on our online study portal in the online course. So maybe you can enroll in the course. It's $390 per paper, and you will get access to all the content in the financial management as well as the financial risk management that they are looking for. And we covered everything, all the risks, currency features, money market hedge, currency swaps, netting off, all of the issues you need under that is covered in the full course. So maybe you can enroll in the course, Paul Amako, so that you will be able to get access to the full content. Bona Stephen Akomia said, good evening, sir. Today I'm late to class. All right, Stephen, no worries. You can watch the playback of the lecture. So no problem about that. Once the live stream ends, you can watch, you can rewatch it because it will be available on the portal. Quinn said, could you please go up? Okay. On this same page, I guess. All right. So IAS 38 intangible assets. And like I said, we are starting with the intangible assets. And as we build up, the impairment of assets is going to be coming in automatically as we go ahead. I see some of you jumping on. We are looking at the Ifrs Masterclass. Remember, you can enroll in our full course online to study directly under my mentorship for the ICA May 2021 examination. It is $390 Ghana cedis per paper, and you can enroll in the full course, get access, and be able to study under my mentorship. So the link is in the description of this video, as well as pinned to the chat. You can get that and be able to watch it. Okay, so that is it. So we've looked at the issue in relation to the initial recognition criteria. We've looked at the treatment of the cost and all of those things. So when it comes to the initial recognition of the intangible assets, what do? Simple. We debit intangible assets with the initial cost of that intangible asset. Then we'll credit cash or bank if it is outstanding, or bank if we use check, or payables if it is outstanding. So when we say debit intangible assets, you debit that particular intangible asset that we are talking about. So it could be a franchise. If we bought a franchise, we could put it there as a franchise. If it is about development cost, That could be there in that case. If it is about patents, it could be there in that case, and any other forms of intangible assets, we could bring it up in there. So that is the initial recognition. The next thing is the subsequent measurement. The subsequent measurement. The subsequent measurement. Now, for time constraint purposes, I'm going to be concluding around here today. And God willing, tomorrow, Friday at 4:30 p.m. GMT, I'll be coming your way so that we can continue with this discussion. Like I said, our lectures for the May 2021 is ongoing. And today, level 2 is financial management, and level 3 is advanced audit and assurance. And I got to sign in and then prepare for the class this evening. So I'm going to conclude around here today for our discussion, and God willing, tomorrow same time 4:30 p.m. I'm going to come your way so that we continue with the IFRS Masterclass with our focus on IAS 38 and then IAS 36. So tomorrow we'll look at subsequent measurement, look at how the treatment is done. Then as we are doing the subsequent measurement, impairment is going to come in. Then we're going to be practicing some questions, solving some questions to see how this can be treated in total in that case. So that is what you need to understand. And that will be all for today. So if there are any questions, you can put them in the chat box. You can put them in the comment box. I'll be replying to all of your questions, all of your comments. You can call or WhatsApp at 050-114-9296, 050-114-9296. The number is in the chat, and you can also find it in the description of the video and be able to reach us. So thank you very much. It's always a pleasure coming your way. Holy T, Felix Colbert, Kiana, Nicholas, Quenu, Benedict, Mercy, Nicole Williams, Jeremy Rose, Leonard, Francisca, Mustafa, Benedict, and all of you guys. Paul, thank you very much for joining the stream. It's always a pleasure coming your way. I'll see you same time tomorrow. Till we meet tomorrow, stay safe, stay blessed, and bye-bye.